Now that we've added our CapEx on as well as our loan, now we can take into account taxes, right? If you recall, we added our tax expense on, right? We're paying 25% of taxes. And in this case, it reduces our net income, right? We still see that is reflected up here in our statement of cash flows. But now we need to think about how are we paying those taxes, right? In our example, we're actually paying those taxes on a delayed basis. So while we've done the economic activity that gives rise to the taxes, and thus they're on the income statement, right? The idea of the income statement, again, is that we want to capture any economic activity that happens in a period. So those taxes were effectively earned in that period. Now we actually want to consider when we pay for it, though. And we see that we're not going to pay for it until next year, kind of like waiting until tax day in the following year to pay your taxes. And as a result, we have this taxes payable on the liabilities side of the balance sheet. All right, so taxes payable, the fact that we've incurred them, but we have not paid them, essentially means we're getting a short-term loan from the government. Because they've given us a loan, that increases our cash. So that's where the sense that which taxes payable, when they increase, that's a source of cash, and it's going to make increase our statement of cash flows. All right, because again, cash is on an opposite side of the balance sheet from the taxes payable, asset versus a liability, so they have to move in the same direction, whether up or down. All right, so now we can model that in our statement of cash flows by setting our taxes payable equal to the end of the period minus the beginning of the period. No negative sign out front since it's going the same direction as cash. Once we add that in, we see our cash flow from operations updates. We can now double check that it's incorporating all the three items into our change in cash. It looks correct. And now we see our ending cash is properly matching the change in cash. All right, let's actually take a step back and undo that change. When we do that, now we notice that our ending cash no longer matches the cash on the balance sheet. All right, this is why the statement of cash flows is such a good check for us that our model is internally consistent. All right, there are times where you're going to build more complicated models with more lines, and it's easy to lose track of one line or another. And to make sure our model works, we can then use this statement of cash flows as a check. Once we get to this point in the model, we see, oh, we're off. How much are we off by? Let's do a quick calculation. 1806 minus what we're shooting for, $369. Once you see you're off by $369, if you look through the balance sheet, there we see a $369 amount. That'll clue us into what we forgot. Again, now we can go back and fix our taxes payable and incorporate that change in taxes payable on our statement of cash flows. All right, our last tab that we're going to look at is adding the stock, right? We went out and we raised some common stock via crowdfunding, and so now we want to incorporate that into our statement of cash flows. This is another financing activity, right? It's a way we're raising capital, and so it goes in those financing activities. And here, just like with the long-term debt, we're going to take end of period minus the beginning. Don't need a negative out front because it's on this opposite side of cash, right? Cash is an asset. Equity is going to be an equity account, opposite sides of the balance sheet, so they're going to move in the same direction. So here we can just do end of period minus beginning of period. We have our 10,000. We can now update our cash flow from financing to add up both stock financing and debt financing. When that all updates, we see that our ending cash now is matching our cash on the balance sheet. And now you see that we have a much bigger model, right? We still have it staggered off between the two periods. This is where it would be nice to just go ahead and move this. Let's move it down a little ways. We'll bring it down here. Change our formatting just slightly. And then the last thing I want to put in here, and I'll zoom back out so you can see everything, is I want to put my check in. So my last check value is checking whether the ending cash is equal to the cash on my balance sheet. And that final true statement lets me be confident that my model is internally consistent and working. All right, so if we zoom out, we can start to see the view of the entire model. It's not very friendly for looking at now from your video, but you can see our model is nicely stacked. We have all of year one in one column, income statement, then balance sheet, then the statement of cash flows. We know it's internally consistent because the balance sheet balances. The statement of cash flow verifies that the cash matches its calculation to what's actually on the balance sheet. and we're confident our model is working.